Learning Objective 1 is to explain how variable costing differs from absorption costing and compute unit product costs under each method. 3 simplifying assumptions. 1. This chapter uses actual costing rather than the normal costing approach that was used in the job order costing chapters. 2. This chapter always uses the actual number of units produced as the allocation base for assigning actual fixed manufacturing overhead costs to products. 3. This chapter always assumes that the variable manufacturing costs per unit and the total fixed manufacturing overhead cost per period remain constant. Under variable costing, only costs of production that vary with output are treated as product costs. The cost of a unit of product consists of direct materials, direct labor, and variable manufacturing overhead. Fixed manufacturing overhead and both variable and fixed selling and administrative expenses are treated as period costs. Absorption costing treats all costs of production as product costs. Under absorption costing, the cost of a unit of product consists of direct materials, direct labor, and both variable and fixed manufacturing overhead. Variable and fixed selling and administrative expenses are treated as period costs. Which method will produce the highest values for work in process and finished goods inventory? To answer this question, remember which method includes more manufacturing costs in the unit product cost. Absorption costing produces the highest inventory values because it treats fixed manufacturing overhead as a product cost. Under variable costing, fixed manufacturing overhead is expensed as incurred and never becomes a part of the product cost. Harvey Company produces 25,000 units of a single product annually. Variable costs per unit total $10 for direct materials, direct labor, and variable manufacturing overhead. Variable selling and administrative expenses are $3 per unit. Fixed costs per year are $150,000 for manufacturing overhead and $100,000 for selling and administrative expenses. Unit product costs under absorption and variable costing are $16 and $10 respectively. Under absorption costing, all production costs, variable and fixed, are included when determining unit product cost. Under variable costing, only the variable production costs are included in product costs. Learning Objective 2 is to prepare income statements using both variable and absorption costing. Harvey Company sold 20,000 units during the year at a price of $30 each. There was no beginning inventory. Let's compute net operating income using both absorption and variable costing. The variable costing income statement is prepared using a contribution format. All variable expenses are subtracted from sales to get contribution margin. Cost of goods sold includes the $10 of variable manufacturing costs only. All fixed manufacturing overhead is expensed, along with the fixed selling and administrative expenses. These amounts are subtracted from contribution margin to compute the net operating of $90,000. On the absorption costing income statement, the unit product cost is $16. Cost of goods sold for the 20,000 units sold is subtracted from sales to compute gross margin. Both variable and fixed selling and administrative expenses are deducted from gross margin to compute net operating income of $120,000. Fixed manufacturing overhead deferred in inventory is equal to the 5,000 unsold units times $6 fixed manufacturing overhead per unit, or $30,000. Learning Objective 3 is to reconcile variable costing and absorption costing net operating incomes and explain why the two amounts differ. Under absorption costing, $120,000 of fixed manufacturing overhead is included in cost of goods sold, and $30,000 is deferred in ending inventory as an asset on the balance sheet. Under variable costing, the entire $150,000 of fixed manufacturing overhead is treated as a period expense. To reconcile the difference between absorption and variable income, add the $30,000 of fixed manufacturing overhead costs deferred in ending inventory under absorption costing to the $90,000 of variable costing net operating income. This equals the absorption costing net operating income of $120,000. In the second year, Harvey Company produces 25,000 units. The selling price per unit, variable costs per unit, total fixed costs, and number of units produced remain unchanged. 5,000 units are in beginning inventory, which are the unsold units from year 1. Since the variable costs per unit, total fixed costs, and the number of units produced remain unchanged, the unit cost computations also remain unchanged. Variable cost of goods sold includes the variable manufacturing costs only. Just as in year 1, the variable costing income statement for year 2 is prepared using a contribution format. All variable expenses are subtracted from sales to get contribution margin. Cost of goods sold includes the $10 of variable manufacturing costs only. All fixed manufacturing overhead is expensed, along with the fixed selling and administrative expenses. These amounts are subtracted from contribution margin to compute the net operating of $260,000. Of the 30,000 units sold in the second year, 25,000 units were produced in the second year and 5,000 units came from beginning inventory. Selling and administrative expenses are deducted from gross margin to obtain the net operating income of $230,000. Fixed manufacturing overhead released from inventory is 5,000 units sold in the second year that were produced in the first year, times $6 of fixed overhead per unit, or $30,000. To reconcile the difference between absorption and variable income, deduct the $30,000 of fixed manufacturing overhead costs released from ending inventory under absorption costing from the $260,000 of variable costing net operating income. This equals the absorption costing net operating income of $230,000. Across the 2-year time frame, both methods reported the same total net operating income, $350,000. That is because for the 2-year period, the total number of units produced equals the total number of units sold. When units produced equal units sold, there is no effect on inventory and the two methods report the same net operating income. When units produced are greater units sold, inventory increases and absorption income is greater than variable costing income. When units produced are less than units sold, inventory decreases and absorption costing income is less than variable costing income. Variable costing categorizes costs as variable and fixed, so it is much easier to use this income statement format for CVP analysis. Because absorption costing assigns fixed manufacturing overhead costs to units produced, $6 per unit for Harvey Company, a portion of fixed manufacturing overhead resides in inventory when units remain unsold. The potential result is positive operating income when the number of units sold is less than the break-even point. Variable costing income is only affected by changes in unit sales. It is not affected by the number of units produced. As a general rule, when sales go up, net operating income goes up, and vice versa. Absorption costing income is influenced by changes in unit sales and units of production. Net operating income can be increased simply by producing more units, even if those units are not sold. Variable costing correctly identifies the additional variable costs incurred to make one more unit, $10 per unit for Harvey Company. It also emphasizes the impact of total fixed costs on profits. Because absorption costing assigns fixed manufacturing overhead costs to units produced, $6 per unit for Harvey Company, it gives the impression that fixed manufacturing overhead is variable with respect to the number of units produced, but it is not. The result can be inappropriate pricing decisions and product discontinuation decisions. Learning Objective 4 is to prepare a segmented income statement that differentiates traceable fixed costs from common fixed costs and use it to make decisions. A segment is any part or activity of an organization about which a manager seeks cost, revenue, or profit data. Examples of segments include an individual store, a service center, or a sales territory. There are two keys to building segmented income statements. A contribution format should be used because it separates fixed from variable costs and it enables the calculation of a contribution margin. Traceable fixed costs should be separated from common fixed costs to enable the calculation of a segment margin. Traceable fixed costs arise because of the existence of a particular segment and would disappear over time if the segment itself disappeared. Examples of traceable fixed costs include The salary of the Fritos product manager at PepsiCo is a traceable fixed cost of the Fritos business segment of PepsiCo. The maintenance cost for the building in which Boeing 747s are assembled is a traceable fixed cost of the 747 business segment of Boeing. Common fixed costs arise because of the overall operation of the company and would not disappear if any particular segment were eliminated. Examples of common fixed costs include the salary of the CEO of General Motors is a common fixed cost of the various divisions of General Motors. The cost of heating a Safeway or Kroger grocery store is a common fixed cost of the various departments. It is important to realize that the traceable fixed costs of one segment may be a common fixed cost of another segment. For example, the landing fee paid to land an airplane at an airport is traceable to a particular flight, but it is not traceable to first class, business class, and economy class passengers. The segment margin, which is computed by subtracting the traceable fixed costs of a segment from its contribution margin, is the best gauge of the long-run profitability of a segment. Traceable fixed costs should be assigned to segments. Don't allocate common costs to segments. Weber Incorporated has two divisions, the Computer Division and the Television Division. Let's look more closely at the Television Division's income statement. Our approach to segment reporting uses the contribution format. Notice that cost of goods sold consists of variable manufacturing costs. Fixed and variable costs are listed in separate sections. Our approach to segment reporting uses the contribution format. Also notice that contribution margin is computed by taking sales minus variable costs. Segment margin is television's contribution to profits. The television and computer divisions' segment margins sum to the segment margin shown for the entire company. The $25,000 of common expenses for the company as a whole should not be allocated to the divisions. These expenses would remain even if one of the divisions were eliminated. As previously mentioned, fixed expenses that are traceable to one segment can become common fixed expenses if the company is divided into smaller segments. Let's see how this works using the Weber Incorporated example. Weber's television division has two product lines, regular and big screen. Assume the segment margins for these two product lines are as shown. Fixed costs directly traced to the television division consist of the $80,000 traceable to the two product lines plus $10,000 in common expenses for a total of $90,000. Once a company prepares a contribution format segmented income statement, it can use the statement to make decisions and perform break-even analysis. Assume Weber believes that spending $5,000 in additional advertising will increase the television division's sales of regular and big screen televisions by 5%. A 5% increase in sales increases the segment margin for regular televisions by $5,250 and the segment margin for big screen televisions by $2,250. Subtracting the $5,000 in additional advertising as a common expense results in a divisional margin increase of $2,500. Learning Objective 5 is to compute company-wide and segment break-even points for a company with traceable fixed costs. The company-wide income statement is used to calculate the company-wide break-even point. Calculate the company-wide break-even point using the segmented income statements. The company-wide break-even point is computed by dividing the sum of the company's traceable fixed expenses and common fixed expenses by the company's overall contribution margin ratio. $195,000 divided by 54% computes a break-even point of $361,111. Division margins are used to calculate the break-even point for each business segment. A business segment's break-even point is computed by dividing its traceable fixed expenses by its contribution margin ratio. The break-even points computed for the two product lines are $180,000 for television and $133,333 for computer. Notice the $25,000 of company-wide common fixed expenses are excluded from the segment break-even calculations because the common fixed expenses are not traceable to segments and are not influenced by segment-level decisions. Costs assigned to a segment should include all costs attributable to that segment from the company's entire value chain. Business functions making up the value chain include R&D, product design, manufacturing, marketing, distribution, and customer service. Inappropriate allocation of costs among segments include failure to trace costs directly. Costs that can be traced directly to specific segments of a company should not be allocated to other segments. Inappropriate allocation base. Some companies allocate costs to segments using arbitrary bases. Costs should be allocated to segments only when the allocation base actually drives the cost being allocated. Common costs should not be arbitrarily allocated to segments based on the rationale that someone has to cover the common costs, for two reasons. 1. This practice may make a profitable business segment appear to be unprofitable. 2. Allocating common fixed costs forces managers to be held accountable for costs that they cannot control. Assume that Hoagland's Lakeshore prepared the segmented income statement as shown. How much of the common fixed expense of $200,000 can be avoided by eliminating the bar? None of it. Common fixed expenses cannot be eliminated by dropping one of the segments. Suppose square feet is used as the basis for allocating the common fixed expense of $200,000. How much would be allocated to the bar if the bar occupies 1,000 square feet and the restaurant 9,000 square feet? The bar would be allocated 1/10 of the cost, or $20,000. If Hoagland's allocates its common fixed expenses to the bar and the restaurant, what would be the reported profit of each segment? Hoagland's segmented income statement. When the common expense of $200,000 are allocated, the bar has a net operating loss of $6,000 and the restaurant has a net operating profit of $50,000. Should the bar be eliminated? The correct answer is no. The profit was $44,000 before eliminating the bar. If eliminated, profit drops to $30,000 because none of the common expenses were eliminated. Both U.S. GAAP and IFRS require absorption costing for external reports. Since absorption costing is required for external reporting, most companies also use it for internal reports, rather than incurring the additional cost of maintaining a separate variable cost system for internal reporting. Advocates of absorption costing argue that fixed manufacturing costs must be assigned to products to properly match revenues and costs. Advocates of variable costing view fixed manufacturing costs as capacity costs that will be incurred even if nothing is produced. Both U.S. GAAP and IFRS require publicly traded companies to include segmented financial data in their annual reports. 1. Companies must report segmented results to shareholders using the same methods that are used for internal segmented reports. 2. This requirement motivates managers to avoid using the contribution approach for internal reporting purposes because if they did, they would be required to A. Share this sensitive data with the public, B. Reconcile these reports with applicable rules for consolidated reporting purposes. End of Chapter 7.